Let's set the stage here. We're looking at a daily chart of the S&P 500 as of the close on Friday, January 13th. With all of these slides, they're best viewed in full screen, so you can click on the square in the lower right corner of your video player to go to full screen mode. To exit full screen mode, just hit the escape key on your keyboard. Let's look at these trend lines first. Here's where we closed on Friday. You can see these two here and here are parallel trend lines, and you can see with these arrows, these show you areas of support. The green arrows, the orange ones show you resistance. So we've acted as support and resistance here several times. It's acting as resistance in the short term here. If I draw a parallel trend line up here, you can see somewhat of the maximum upside, maybe that seems relatively realistic if we were to break into this part of the channel. We've also got this downward sloping trend line from the market highs that intersected with these summer highs. And we've also got another line here that caps some of these highs here. So these are just some areas to watch. You can pause it and look potentially at the levels. What we're going to be looking for in the short term is this. We believe that we're getting close to some type of top, whether it's in short-term, intermediate top, long-term top, that remains to be seen. We're going to keep an open mind about that. We would guess that if we are going down relatively soon, we would expect these levels over here to hold, let's say, in the week after the downgrades, especially these two levels. Really wouldn't expect us to exceed 1316. It's possible we could pop up here. If we exceed these levels, especially clearly and convincingly the week after the downgrades, I think that throws out the short-term topping scenario here and leans towards a bullish scenario. But let's assume that the short-term topping scenario does play out. We would expect these to hold. If we were to come down in this direction over here, here are the levels that we're going to be watching on the downside. You could expect to see some type of bounce in these areas. Again, if the market holds here and moves back up in a bullish manner, that may discount the case of coming down into this area here. If we come down in a forceful manner, you could also see some type of bounce around 1218-ish, 1220-ish. The ultimate target, we think, if we do come down and have a corrective activity, would be somewhere in the neighborhood of 1150, 1160. But that's one possible scenario. In terms of upside, this channel here around 1375-ish makes some sense. You can make a case that 1350 comes into play. And we've got another slide that shows that it's even possible, and you can make a logical case even within the context of a bear market or trend exhaustion, that we might even try to exceed this high here. We also have some potentially bullish developments. This red line is a 200-day moving average, just a 50-day moving average. You can see price right now is above both, and all things being equal, that gives the bulls the benefit of the doubt. The other development that we need to keep an eye on is this 200-day moving average is still sloping downward in a bearish manner, but it is trying to flatten out here, which again gives the bulls the benefit of the doubt looking at this chart in isolation. And we're going to look at the 2008 bear market and speak to this a little bit as to why this may not be as important as it appears to be. With where this is right now, it's important that we keep an open mind about upside potential, as well as scenarios that say maybe this isn't as important as it appears to be. But there's no question that this, and this 50, 200 price have improved, and you have to keep an open mind about potential upside, especially with a lot of money printing that's going on in the expansion of the European Central Bank's or ECB's balance sheet. One of the reasons why the chart of the S&P 500 is starting to look a little bit more healthy in terms of moving averages is a concept that in the present day, the United States is going to decouple economically from the situation in Europe, which speaks to the fact that we would be able to insulate ourselves from those problems. The theory being that Europe could go into a recession and the United States would avoid a recession and decouple itself or insulate itself from those problems. Let's go back and look at the last bear market, which was kicked off by subprime mortgages, and revisit the decoupling theory and how that worked out for investors. This is the Emerging Markets Index. This is the S&P 500. In the 2007 to 2009 bear market, the problems were based out of the United States. The housing bust, subprime, bundling of mortgages, the securitization of mortgages, all centered in the United States. So let's say it was a U.S.-centric problem. In 2007 and in 2008, the theory on Wall Street was that the emerging markets were going to decouple from the United States. They didn't have a property bubble, they didn't have a subprime crisis, and therefore they were going to be fine, and the emerging markets were the safe haven place to be. And this is the 200-day moving average, the blue line's the 50-day, 200-day, 50-day. And that belief was reflected in the technicals as well as the belief in the fundamentals. In the United States, where the problems were centered, our 200-day moving average rolls over very early in 2008. We get the bearish cross of the 50-day below the 200-day. So by the textbook definition, downward sloping 200-day moving average, 50-day below the 200-day, and price below the 200-day tends to be the textbook definition in our minds of a bear market. And as you can see, the decoupling theory allowed the emerging markets to avoid that. So in 2007, even though these markets came down sharply, they were able to retake the 200-day moving average. And if you look at this chart here, it looks very similar to what the chart of the S&P 500 looks like today. You've got price above a 200-day moving average that's relatively flat, and you've got a 50-day moving average that's moving towards the 200-day moving average. If it were to cross back above, that's known as a golden cross. And the argument from where we sit now is the current problems are based in Europe. So there are some analogies to saying that how this index held up is similar to the way that the S&P 500 is holding up in the present day. So a fair question to ask in terms of learning from this experience would be, how did the decoupling theory work out, both economically, and how did investors do who bought into the decoupling theory right here in early 2008? The answer to that question is not very well. So we're looking at the same two charts here. We've just fast-forwarded a little bit. To put this into context, this is the present-day chart of the S&P 500, and this is one of the European indices. So the analogy in today's world is that the S&P 500 is the new decoupling emerging markets, and the European indices are analogous to the S&P 500 in the subprime crisis. So here's where we are today. If you were to look at this chart over here, you could make a case that we're right about here. The 50 days come down, price came down, you had a big correction, and then we came up, and we were able to retake the 200-day moving average. And in fact, you could even make an argument that we're here because we've exceeded this high in the present day. So this piece is similar to this piece. And as you can see, eventually, economically, technically, from an investment standpoint, the decoupling theory, without really any surprise at all, doesn't tend to hold water in the world that we live in today. The takeaways are that while the S&P 500 never really broke the bear market mold and looked like a bear market during this whole time, that's true today of the European indices. While we look pretty decent up here, this looks just as bad as this did over here. This still looks very much like a bear market. Downward sloping 200-day moving average. You got a 50-day below the 200-day, and presently, as of the close on Friday the 13th, you have price that's below a downward sloping 50-day and below a downward sloping 200-day. Looks like a bear market. The point of the story is, don't believe that decoupling theory is going to play out. It could, and it's something that we need to respect, and we need to respect that this chart looks like this. The other thing that we need to respect is that this rally via the decoupling theory did last for quite a while. In fact, this market made another push at these all-time highs up here in the summer of 2008, which says if this scenario played out, we could see higher prices here. It's not out of the realm of reason, and we'll show later that if you look at DeMark counts and price exhaustion, you can make a very legitimate argument that the S&P 500 could even try to challenge this all-time high here at 1370. We can throw another skeptical dart at the decoupling board, looking at just some other indices around the globe. This is Australia. Looks like a bear market. United Kingdom, 2012, looks like a bear market. China, 2012, looks like a bear market. Germany, 2012, looks like a bear market. So the point here is, unless you believe that the United States can decouple and every other region around the globe is experiencing a bear market and has succumbed to all of the fundamental concerns that we've had since the spring of 2011, then you have to believe the decoupling theory. A lot of things have to happen technically in all of these markets around the globe. There's your 200-day, there's your 50-day, to erase what clearly looks like bear markets. To take the bullish side of that, if they print enough money around the globe, if the Fed starts QE3, which wouldn't be a surprise, it's possible that enough money printing may be able to get these markets to push higher. Another fundamental scenario that could push these markets higher that we have to be aware of is if Greece is able to come up with some market-acceptable solution to the impending debt deadlines in March of 2012, that's also a possible catalyst for the bullish case. We mentioned in a previous slide that if you follow DeMark counts, which look at trend exhaustion, monthly DeMark counts, you can make an argument that to see trend exhaustion, the S&P 500 on one of the counts would have to close above this high here, which was known as bar 11, which would be 1370.58. Just looking at simple trend lines, you can see there is a little white space here. Even if we reversed, you could potentially see some more upside above this close of 1289.09, which occurred on the 13th of January. Again, this is a monthly chart of the S&P 500. As far as DeMark counts go, DeMark has four major counts that he looks like. There's a sequential, there's a combo, there's an aggressive sequential, and an aggressive combo. Out of those four on monthly charts of the S&P 500 index, you have trend exhaustion signals on two of the four. So 50% of them say that this high probably would not be retaken or challenged, and half of them say that it is reasonable that we could potentially challenge this high, run up here, or even close above 1370.58 on a monthly basis. As far as assigning probabilities to that, I think it's just too early. You have to really see what happens, get a little bit more information before I'd really assign any probabilities to this. The fact that I'm showing it to you says that I believe that it's in the realm of possibility and something that we have to plan for. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.